Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Oil and gas stocks are still getting a ton of attention, and for good reason. The oil industry has shifted into a profit-focused phase. And as much as a lot of the stocks have run up, there are still opportunities. We're going to talk about one that my friend Tyler Crow just bought. I'm Jason Hall. This is The Smattering. And I've got Tyler on here to talk about it. But first, there's a company that Tyler absolutely loves, one of the oil majors, ExxonMobil. But that's not the stock that Tyler just bought. Hey, Tyler.
How's it going, Jason? Really leading me in with a nice little teaser there. Yeah, it wasn't ExxonMobil this time. It's a company I've owned for a really long time, but I actually think there's just better value out there right now. And
Right. Particularly if you're deploying new capital.
exactly, one that I recently purchased and one that I have been very impressed with recently is Equinor. For those who haven't heard of it before, it is basically the state-owned oil and gas company for the country of Norway. It's about 60% owned by the country of Norway, with the rest of it being a public float. And the majority of its business is owning the Norwegian continental shelf of offshore oil and gas drilling, which, for those who are unfamiliar, the Norwegian continental shelf is one of the more attractive places to drill and extract oil. It's a pretty low cost place to develop oil and gas. And you just happen to have a nice captive market with Europe sitting right there without a lot of its own resources. There was a period, this was a few years ago when I was looking at statistics, and it obviously has changed since then, but there was a period where the combined Russia and Norway were more than 40% of Europe's natural gas. And now Norway has been an even larger contributor there because it's one of the only games in town that has pipeline access to mainland Europe. But that kind of makes it sound like it's just a play on the energy crisis in Europe with Russia, but it really isn't. It is an extremely profitable business today and going forward. We've talked a lot about oil and gas being very disciplined these days on cost and capital deployment. And really, Equinor is no different. They're looking to grow production 2 to 3% annually, and costs are about $20 per barrel. So if you look at today's prices, even though we're down from the craziness of the Ukraine war, it's
Right. About
still
a year ago, a little more than a year ago, oil was over $120 a barrel for a brief period and was triple digits for an extended period of time. But again, we're
yep.
down now between 70 and 85, depending on the week you might watch this video. But again, that floor of $20 puts it in competition with some of the cheapest oil in the world that's profitable in just about any environment.
And so as a result of kind of all of this, we have a company that is generating loads of cash and doesn't have a lot of places to put it other than buying back shares and paying both regular and special dividends, which, hey, if I'm a shareholder, that sounds awesome to me. If you don't have anything you want to do, particularly your free cash flow, give it to me. I'll use it. And so just to give an example right now, based on its trailing 12 months, it's generated about $8.56 per share in free cash flow. That means it's trading for 3.4, 3.5 times free cash flow. Incredibly cheap. And
As for comparison's sake, I think if you look at some of the other European, especially the US majors, the European ones are all a little bit cheaper right now. Typically, a good value would be low to mid teens, would be a reasonable price to pay for one of these similar businesses. So this is extremely discounted.
and at the same time that it's spewing out all this cash, it still is holding a lot of it on the books. Like I said, this is a $86 billion market cap company, and it has $50 billion in cash sitting on the books. Net out its debt, it's a little bit closer to 21 billion. But either way, you're looking at a company with a huge cash position that just doesn't have really much else to do with it other than buy back stock and pay special dividends for a considerable amount of time. Now, the clear path that management has put out says we're going to be very disciplined with our growth. We have some renewable stuff we want to spend on, but we're not going to be egregious with our spending. And we're going to buy back lots of stock and return capital to shareholders because that's what the shareholders want, both public and Norway, who has approved a lot of these capital plans. So when you piece that all together, To me, this looks like one of the better opportunities in oil and gas compared to some of the other ones who are good in their own right, but just much more expensive right now.
Tyler, I will tell you, and the folks watching this as well, this is a company you and I have been talking about for a while, and I tend to be pretty disciplined with my oil and gas investments and find specific companies that I know really well that I tend to stick with that have done well for me in the past. And in my case, Phillips 66 is one of the larger companies that I've consistently looked at and invested in when the market gave me the opportunity to buy at a discounted price. But I joined you in investing in Equinor here in the past week. So this is one that I'm joining you and talking my book about too. So folks, check it out. I think it's certainly worth a look right now.